Well, good afternoon, everybody. Welcome to Sharpen Your Edge and Learn to Trade Fearlessly. This is, believe it or not, session 18. We're going to be doing from the book Volume Price Analysis, a complete guide to volume price analysis by Anna Calling. We're going to be doing chapter 8. This is really book 1, and this is Dynamic Trends and Trend Lines. The loss was not bad luck. It was bad analysis, said by David Einhorn many years ago. What I'm going to be reading from, I'll be reading a lot from the book. And this is Ann Calling's opinions on many things. So I try to put her name in wherever I can to get the right pronoun in. But in case I don't, just know that oftentimes if I say I, it's her who's really talking. So in this chapter, Anne wants to explore the concept of trends and trend lines, and no doubt you will have heard the oft-quoted term, let the trend be your friend, which in her humble opinion is more or less meaningless mumbo-jumbo. I don't necessarily agree with that, but we will explore this. It is the mantra of people who profess to be mentors and coaches parrot to their students in an effort to impress. However, just like price congestion, where with hindsight, any fool can see where the market has been trading sideways, so it is with trends. And anyone who quotes this axiom is clearly little live trading experience in her view. Generally, they will show you a lovely trend with several lines on and sagely advise that this was the place to enter and then hold for the duration of the trend before finally exiting at the end of the trend runs higher or lower. All easy stuff when you're considering an historic chart. You know, it's easy to see those things after they are done, but our whole point in this lesson is to identify trends at the beginning of the trend after congestion happens. So let's start with some basic thoughts on trends. And Anne wants to dispel some of the nonsense that has been written on this subject. And the first and most important question is this: how do we know when a trend has started? Well, just as with support and resistance, the short answer is we won't until it's over. It's that simple. It was the same with our congestion phase. We have to have some parameters that give us clues as to whether a trend is beginning to develop in whatever time frame we are considering. As a trader, it's pointless to look back over an extended period, draw some lines on the chart, and then decide this is a trend. But then you will have missed most, if not all, of the move, and are probably just getting in when the insiders are getting out. So this is why VPA is so powerful. It validates the price action for us, and it reveals where we are in the longer-term trend. After all, if we see a selling climax or a buying climax, then we know a new trend is about to begin. We're in at the start, which is where we want to be, not at the end, which is where trend lines inevitably point to, particularly if you only rely on this technique. Now, Anne stresses that she's not saying trend lines are not useful. They are, but only when used in the correct way, which is what I'm going to teach you in this chapter. Now, Dow's original and pioneering work gives us a hook on which to hang our hat. What's also interesting is that in developing his ideas of trend, he also introduced the concept of the 3 stages of a trend as follows. Excuse me. First, the accumulation phase. Second, the technical trend following stage. And third, the distribution stage. If this sounds familiar, then it should be, because this is the cycle the insiders follow in the constant round of first filling and then emptying their warehouses, as developed and explained by Richard Wyckoff. Now, Charles Dow referred to the insiders as the smart money, with the distribution phase of the trend where the smart money is taking its profits and heading for the sign marked exit. At this point, we're going to diverge from standard trend analysis and look at it in a slightly different term, which I hope you will find more useful when trading live rather than the theoretical nonsense that appears in most books. The above introduction has given us the framework to move on, but at this stage, most trend analysis would then present you with this graphic. Here we have the traditional picture of a trend. The market has moved higher in a series of steps, and once we have 3 steps in place, we can draw our upper and lower trend lines, which define the channel clearly. Now, most textbooks will tell you it is impossible to find a trend using 2 points, since the possibilities for interpretation are endless and ultimately meaningless, which is why we have to wait for 3 points before joining them up to create trend lines themselves. These are the higher highs and higher lows, which define the peaks and troughs as the market moves higher, and lower highs and lower lows as the market falls. Now we have a clear picture. A trend has been established. We are ready to enter the market and wait for this trend to develop further. This is the story. This is the theory. But unfortunately, by the time we have waited for 3 higher highs and higher lows, the trend is already reaching a climax. It's over. We've already been through the technical trend following stage, and we are about to buy at the start of a distribution phase. How many times have we, watched a trend move up and up and up or down and down and down? We finally are convinced that it's real. We get into it, and what's it do? It starts going sideways, or worse yet, it reverses. But how do we know this? Because most likely you've been reading too many textbooks written by people who've never traded or invested in their lives. This is all theoretically easy to see in hindsight, and once the trend is this well developed, it's really not much use to us. So what's the answer? And for this, we need to return to support and resistance, which holds the key, and by which Anne covered in such detail in previous chapters. Now, this is yesterday's chart, and we're going to go through this, but I've marked this with the trades we had yesterday on that big swing high, pivot points, and there's more pivot points in here. I didn't mark them all, but I just want you to be aware of this. So support and resistance is where trends are created. So if you look here where I'm pointing on the left side of the screen, you see that we were trending up. We had a clear trend up that we got into for 2 trades. We actually only needed to get in with 1 trade and just hold it until that first pivot point. But then it started going sideways for about 6 or 7 minutes and then broke out. We took trade 3 right at the exact right time to be in that trade. And trade 4 was a bit late, but still yielded a good return. So support and resistance is where trends are created, born, and then propelled on their way. If you see the 2 lines here on the pivot point, these are support and resistance. And of course, up higher, you can see the minor zones. These are support and resistance as well, our traditional support and resistance zones that we use. So this is where accumulation distribution phases occur along with selling and buying climaxes. It's the most important area of price behavior on any chart. It is also where markets pause and move sideways, often ahead of news releases. And here you will see volume decline as participation falls away. The buying and selling climaxes are like the spawning grounds at the head of a great river to which salmon ultimately return to spawn. You can see during that swing high, we had generally higher volume in this green shaded area. And then when it started going sideways, we had a drop off in volume. Now, this is one of the very fundamental keys to volume price analysis is that real moves have to be supported by higher volume. And this is where we start to answer the questions all traders, investors, and speculators have at the forefront of their minds constantly. Is this the start of a trend? And if so, what is the strength of the trend and how far is it likely to run? Now, these questions can only be answered by understanding support and resistance in the context of volume price analysis, as I was just talking about. So let's return to basics and revisit our congestion phase, where the market is moving sideways and creating the floors and ceilings of price support. The market is preparing to break out, and all we need to do as traders, investors, or speculators is wait, be patient, and then validate the breakout using volume. Now, how do we know the extent of the trend at this stage? Well, the short answer is we don't, but we have several clues which allow us to make an educated guess at this stage. First is the extent of the price congestion phase. Again, we must recall Wyckoff's cause and effect, as this will dictate whether we can expect to see a primary, a secondary trend, or a minor trend develop. For an intraday scalper, we're even faster than that. The trend will almost certainly be a minor trend or secondary, but this may well sit within the context of a larger term trend in a slower time frame. In this context, our scalper would then be trading with the dominant trend in a higher time frame. In other words, the minor trend being traded is in the same direction as the longer term trend, which for an intraday trader may be the hourly chart. And as we trade in the mornings, we often look at longer time frames to see what the overall trend is, what the daily trend is. You'll often hear me talk about what the current daily trend is as we trade. This is one of the primary reasons why trading uses multiple charts is so powerful. It helps to frame the trend we are trading. However, there's nothing wrong with taking a trade against the dominant trend in whatever time frame that may be. So, for example, the dominant trend in a stock market may be bullish on the index, but there may be a bearish opportunity in a stock. This is fine as long as we recognize we are trading against the dominant trend. This type of trading is often referred to as counter trend trading. Say that 10 times. So the first step is always the price action immediately following a move away from the price congestion zone. And this is very similar to the way we identified our congestion entrance using the pivot high and pivot low to give us our levels. This gave us our bearings. The previous price action, whatever it may have been, has now paused and is taking a rest. Our pivots have alerted us to this pause, which may be an extended one, in which case the levels will be further reinforced with further pivots to the upper and lower levels, or it may be a temporary one with few pivot points. It may be a reversal, in which case we can expect to see some extensive VPA action, or a continuation of the previous trend. All this will be revealed as the price action in this area unfolds into our traditional congestion area with our ceilings and floors in place. However, at some point, the market will break away, and this is where the pivots come into play again, only this time to help us define the trend as it develops. Furthermore, it allows us to take advantage as soon as possible and not have to wait for the higher highs and higher lows or lower highs and lower lows to develop before entering the position. Let's take an example which shows a breakout to the upside. I'll show that in just a second, but what we're talking about is this is a congestion zone where this pivot point is. We had the swing high happen. We hit a pivot point, which signals to us either the end of this upward trend or the beginning of a reversal or sideways movement. But in other words, we really don't have to get out of this trade until we hit a pivot point, which signals a change in one of those three areas. It also signals the beginning of a new trend. When we hit a pivot point, once we break out, we hit a pivot point. We take that as the beginning of a new trend. Okay. So let's take this example, which shows a breakout to the upper side. As you can see in this graphic, the market has been in a consolidation phase and has broken out on robust volume. Our analysis signals this is a valid move, right? More volume. And we are now looking for signs that this trend is likely to develop. The first signal we have is of market rising on solid and generally rising volume, and we take a position. What we are waiting for now is our first marker, which is just as in the case of our congestion entrance in the previous chapter, is a pivot. And as we are in a bullish phase, we are looking for a pivot high. So you can see the pivot, we've broken out of this range, of this congestion zone, have broken out above the level, and we hit our first pivot point. Now, just to remind you, these are pivot points. What's the pivot point? It's made up of three candles like this. We have a pivot high and we have a pivot low, but they're always made up of three candles in this configuration. So as we know, markers never go up or down in straight lines. As we know, markets never go up or down in straight lines, and this is the first sign of a reversal, which in turn will also define the upper region of our trend as we break away. Remember, the pivot high and the pivot low are combinations of three candles, as shown here. We now have our first point of reference in the price move higher. And since we have a pivot high, we expect some short-term weakness and for the market to reverse lower. This could be a major reversal, which is unlikely given the volume profile and the recent price congestion. But at this stage, we are never sure and must be patient. The volume is falling, which is a good sign. Falling price and falling volume signals weakness in the trend. And in due course, the market stops and reverses higher, posting a pivot low. We now have the second marker in our journey higher, as we can see in this figure. So we break out from congestion, we hit a 3-candle pivot point, we reverse slightly to another pivot point, which is the pivot low, and then we can expect the market to bounce higher, as seen here. Now, we're starting to build a picture of the price action. We have a position in the market, and provided volume continues to confirm price, then all is well with the move higher. The pivot point, which are now forming, are our markers to highlight the journey and define the boundaries of the trend. Now, unlike the trend lines, which most people draw after the event, these are dynamic and created during the price action. And provided they build in a series of higher and lower levels, then we know the trend is developing and we stay in our position provided volume supports our analysis. That is, provided we've got increasing volume. As price continues to rise, we have increasing volume. As you know, we bounced off this pivot low and we continue up. All right, let's go forward now and add 2 more levels to the chart, and based on exactly the same principle. From our current position, we are now looking for the market to push higher off the pivot low, and the next target for us is the second pivot high. And provided this is above the previous pivot high, we're in an upward trend. Once this second pivot high has formed, we expect the market to pull back or pause, but hopefully only in a minor way at this stage and on lower falling volume, at which point we are now looking for our second pivot low. This is duly posted, and provided it is higher than the previous pivot low, we stay in our position, as we are now expecting the market to push off this pivot low and develop the trend further. So the market continues higher as expected, and now we are waiting for our third pivot high, higher than the previous one, which will then define the upper region of our trend. Now, if this is posted as expected, then once again, I'm sure you're getting hopefully you're getting the picture now. The market pulls back off this pivot high and moves lower to post another pivot low. If this is higher than the previous pivot low, then we continue to hold and now have our third pivot low to define the lower region of the trend. This is how we build trend lines dynamically, while simultaneously holding a position in the market based on volume price analysis on VPA and the fundamental principles of VPA breakouts from sideways congestion, as we can see in, let me let somebody in this figure. So this is dynamic trend lines, bullish trend. So you can see what's happening here as the trend develops. We move up, we may pull back a little bit to a pivot low, we push higher to a pivot high, we push down to a pivot low, a little bit higher. But let me come back up to here. This one that we had on Monday, this was such a powerful trend that we didn't get a pivot point until here, until it went into some slight congestion, and then all the way up here, this pivot point, which began this congestion point. We did have a little breakout there above our line, but it was a false breakout. Pivot point showed a reversal. It did. Another pivot point shows us breaking out, and on and on. There's another pivot point up here at the high, another pivot point there. And you can follow these pivot points and and see how they work with volume and how they are showing reversals or congestion. So just imagine this whole process almost as one of scene setting. The congestion phase sets the scene for the price action, which is then delivered and supported by volume. The pivot highlights the journey. They are like the lights on the side of the road, giving us a clear view of where we are, while also giving us the confidence to hold our position in the market. Excuse me one second. So finally, at some point, we see a pivot high posted, which is lower or perhaps at the same level as the previous pivot. It is at this point we are viewing the market that we may be moving into a secondary congestion phase with a pivot low to follow. If this is at a similar level to a previous pivot low, then we're probably entering a congestion phase and our analysis continues. Now we're looking for confirming signals with further pivots and finally a breakout. Again, is this a trend reversal or merely a trend pause? If we break to the downside, then it is a trend reversal from a primary bullish trend to a primary bearish trend. We exit our position at that point. But if it is a trend pause and the trend continues on a break higher, then we hold our position and start the process of building our dynamic trend lines once more. Naturally, the above is a textbook example of what we want to see on every breakout from a congestion phase, but trading life is rarely textbook. Sometimes these pivot points do not appear. For example, on a break higher, the pivot high may not appear, but the pivot low may do so in due course. Yeah, it'd be lovely if they all look like this, wouldn't it? Right. So don't expect to see the perfect scenario on each breakout. Everyone will be different, characterized by varying degrees of momentum and duration. What we have to do is to look for the clues using VPA, like volume, and then wait for the pivots to appear as the price action unfolds. If they do not follow a logical pattern in the trend, then the market is potentially weak and may simply revert back into a period of congestion at a slightly higher level. The price action and associated pivots for a move lower away from congestion phase are created in just the same way. But this time we are looking for a pivot low to form initially, followed by a pivot high, as we can see in this graphic. Note the rising volume on the downtrends and the failing volume on the reversals higher, which are key confirming signals of VPA. So the pivots are formed dynamically, and as they are, whoops, hold on, sorry, I skipped. In summary, to pull this all into some sort of context, there's nothing wrong with drawing what I call static trend lines on a price chart. In many ways, this is what we've done here. The difference, however, is the trend lines in this chapter have been created by a dynamic price action of the market. Nevertheless, what I've tried to describe here is the process of analysis and price action, which describes where we are in our trading journey, or perhaps more importantly, where the market is in its trading journey. The pivots are formed dynamically. That is, they happen as they happen. And as they are created, so the trend is built, which we can then define using these points as our waypoints on the journey. Nothing is ever perfect, but at least using VPA and your understanding of the importance of price congestion should put you in a strong position, allowing you to identify a trend before it starts and not after. So once you've developed a deeper understanding of congestion phases, VPA, and trends, all that remains is for you to decide as a trader the tactical approach to adopt. Are you going to look for reversals, or are you going to wait for the trend to develop before jumping in? As always, there's no right or wrong answer, just what suits you and your risk and money management rules. So that is how we build trend lines. That is the proper way to build trend lines using pivot points and using VPA, volume price analysis, by watching for increased volume as price moves up aggressively or down aggressively. But we look for these pivot lows and these pivot highs. Okay, guys, any questions at this point? Makes perfect sense. I think this is,
Dennis Keith, I was just looking through today's chart trying to pick out the pivots, and yeah, there's a couple that are missing in there. Uh,
yeah,
but so anyway, I like that they admit that, everything isn't ideal like this.
yeah, yeah.
The Are the candles on either side of the actual pivot point usually about the same size candle, or does that matter?
It doesn't matter so much as long as as long as they are in a group of three, with the middle one being the smallest and highest. Right. So here is, let me get a pen out here, and here's today's charts, obviously. Um, here's a beautiful pivot point right here. There's kind of a weak pivot point down here, but you can see as we started this trend higher, we did hit a pivot point here, and we did reverse slightly. We did not get a lower pivot point there before this started higher. We did get another pivot point here, and that signaled, and that's a pivot low, and that signaled another change, but instead it went higher. We have a pivot point up here, which pointed to a reversal, and so on. Looking for some other pivot points in here. So, I mean, sometimes they're there, sometimes they're not there. But what I do find with these pivot points is that, at least from the charts that I've looked at, they signal that a congestion, or either a minor congestion or reversal, is about to happen. So it does give us that. And in my reckoning, it would be a time to get out of a trade when we start going into sideways congestion, when seeing a pivot point. Okay.
And it doesn't, the center, the actual pivot candle, it doesn't matter if it's a high pivot or a low pivot, whether it's a green or red candle, doesn't matter. Or does it?
It does matter in terms of the trend. If we were to go,
So if you've got a pivot, say you've got a bullish trend, and you get a pivot where the pivot says that the trend is getting ready to go, is getting ready to turn down, is that central candle, is it going to be red or green, or in the blue, in the
yeah.
example here, this one looks green or
Yeah.
blue, but
So if we're trending higher,
mhm,
we're looking for a pivot high like this one right here.
mhm.
And you can see that the third candle is red. So it's a bearish candle at the end of that pivot.
Mhm.
And the opposite is true of the pivot low. So if we are moving up, we are likely to, well, not likely, we will see a pivot high. That's the likely pivot that will happen when price is moving higher. When price is moving lower, we're likely to see a pivot low as a signal that something is changing.
And do we take into consideration the wicks on the candles, or just the bodies of the candle?
Just the bodies of the candles.
Yeah.
You can see on these the examples that they gave that the wicks are generally about the same.
Mhm.
They can be a little different, but primarily it's this configuration that we're looking for on these. And by the way, Brian did all the graphics for this. Brian, thank you very much once again for doing great graphics on these.
Thank you, Brian.
So, okay. Any other questions?
So I think also that you were pointing out with the volume, particularly yesterday, that if we don't have volume over roughly 100,000 on some of these, stay out.
Yeah. Yeah. Yeah, I mean, you can see on this graphic here. Let me go from current slide and make it full again. Okay, on yesterday's, we started out with high volume, but that first minute is taken up by pre-market volume coming in. A lot of that early rush from the overnight trades that are coming into the market there. But yeah, we want to see above 100,000. But we're also looking in comparison to other areas. I mean, we can see on this area where we had that tremendous swing high that there was a lot of minutes that were not above 100,000, but a lot of key minutes were above 100,000. But as soon as we got to that pivot high point up here and started going sideways, volume generally decreased, and pretty significantly in some points. Okay. Okay, if there's no other questions.
This is from the Anna Calling book, Tim?
Yep. Yep. This is from Complete Guide to Volume Price Analysis.
Right.
And this is book one of it. There's actually two books. There's another book, Stock Trading and Investing Using Volume Price Analysis, that has a lot of examples in it. I don't know if we'll actually get to that book. We have other things that we want to cover once we get through this. But I think this chapter was one of the most applicable chapters that I've seen so far in terms of tying it all together using pivot points and trends. And I was just noticing that, you know, oftentimes we look to get into breakouts as soon as they break out, as soon as we can determine they have broken out, whether that's 1 minute, 2 minutes, 3 minutes, 4 minutes, you know, as soon as we're convinced. But I trace back the time on this trade 3, and we got into this one just perfectly, I think, at the right time. Trade 1 was good too. Did not need to do trade 2. And in fact, I think Keith stayed in this one, just did one trade on this and stayed in pretty much the whole time and knocked it out of the park on that one. And like I said before, that trade 4 was a bit late, but it's still, you know, there was plenty of profit in there. But using VPA and breakouts from congestion zones, we're going to know to stay in these longer and look for those pivot points. I mean, this was a huge move. You know, there was probably $2, $2.50 in profit on that move. Okay.
Was that one today that we just set up? You just set up?
Yep. This is today's.
That huge move you were just talking about. It's just shy of $4 underlying move.
Wow. No kidding.
Yep.
That's huge. Well, had someone told me I'd have stayed in longer.
Yeah.
Okay. All right. Let's see if let me stop the recording for now.